Okay, so thanks again for joining. As you probably know, the call or the webinar this morning is on the recently legislated Secure Act and its impact to all of our collective retirement planning. I'm going to spend roughly 20, 25, maybe 30 minutes going through some prepared content and slides, but I'm happy to answer questions along the way and do my best to answer any of your questions at the end of the presentation as well. So don't hesitate to speak up if you want me to stop and go back through something or go through something in more detail. So let's begin with the Secure Act. So what is it? So the Secure Act stands for, it's one of these great government acronyms. It stands for Setting Every Community Up for Retirement Enhancement. And it was passed, as you can see on the screen, by the House in July of last year, and then it was approved by the Senate in mid-December, and the President signed it into law on December 20th. It became effective on January 1st. As I'll share a little bit later as we get into the presentation, while I understand the idea behind the SECURE acronym, I think it might have been better labeled the Tax Revenue Acceleration Act, because as we'll touch on in a little bit, I think this is really just an opportunity for the government to get their hands on some tax revenue quicker than they would have otherwise, but we'll touch on that in a minute here. So in the SECURE Act, as with most legislation coming out of Washington, D.C., there are a lot of changes, and I'm not going to dwell too much on any of the bullet points on this page, but I do want to highlight a few of them. There are some annuity-related changes, and for any of you that know me or have read my writing over the years, you know that I'm generally not a fan of annuities, but basically they have made it easier for 401ks and business retirement plans to include annuities in their plans. I'm not a fan of that, but apparently the insurance lobby in Washington is alive and well funded, I might add. There's a new contribution eligibility for IRAs. So previously, you could not contribute to an IRA beyond age 70 and a half, which coincided with the age at which required minimum distributions from IRAs were required to begin. That's gone away. So if you are working and have earned income beyond age 70, or 70 and a half to be specific, you can now contribute to an IRA. I don't know that many folks would need or want to take advantage of that, but that's now on the table and a new option. There are some expanded capabilities with college 529 savings plans. So you can now use up to $10,000 out of your 529 to pay for school debt, and that can be $10,000 per person. So let's say that your name is on a 529 account for the benefit of a child or for a grandchild. You can now use up to $10,000 of those account dollars to pay off qualifying student loan debt. And let's say you've got 3 grandchildren and you can only have one of your grandchildren's name on the 529. You could use $10,000 to pay off school debt for one of your grandchildren. You could change the beneficiary to another one of your grandchildren, use another $10,000 to pay off school debt, and then do that once again. So you could actually pay up to $30,000 of school debt across three grandchildren in this example. There are some new opportunities to get access to your funds in IRAs and other retirement accounts. Specifically, there are some new penalty-free options to withdraw funds for childbirth or adoption-related expenses, and that can be up to $5,000 per event. And as I mentioned, there are many, many other things included in this legislation. I'm not going to focus on that today. I really want to focus mostly on the aspects of the legislation that are going to impact your retirement and retirement planning decisions. So let's jump into those now. Let me slide this up here a little bit. So the biggest changes coming from the Secure Act, they're going to impact your retirement or the retirement of those that you care about and that are important to you. have to deal with required minimum distributions, which I'll often refer to as RMDs later in this presentation. But if you see RMDs, I'm talking about required minimum distributions. And then there's no more stretch IRAs. And I'll talk a little bit more about what both of these mean here in a moment. But if you have money in a 401k, an IRA, a 403b, a 457 plan, if you're a government employee and have money in the thrift savings plan, these are all retirement accounts, and they will all fall under the new rules set out by the Secure Act. So this is legislation that impacts, if not everybody, certainly a lot of folks. So let's begin with required minimum distributions, or RMDs. They get pushed back, not a lot, but a little. So formerly, prior to January 1st of this year, RMDs were required to begin when an IRA or retirement account holder reached age 70 and a half. And that's another one of those government quirks. Why not 70 or 71? They picked 70 and a half, probably just to make this as confusing as possible for all of us. But they changed that with the Secure Act. Required minimum distributions now begin at age 72. And there's some rules around that, which I'll touch on in a moment. But just know this, required minimum distributions are important. And if you miss them, there are steep penalties, like up to 50% penalties. So you want to make sure that you plan for these and accommodate for these. And if you have multiple IRAs, or if you have, let's say, a 401k at a former employer and 2 IRAs at Fidelity or Schwab or wherever, your RMD amount is based on the collective value of all of those accounts. So you need to take that into account and plan accordingly. Let's see. Again, just a reminder, if anyone has any questions or comments as we're going through this stuff, type them in the chat box or the Q&A box, and I'll be happy to address those. So to get into a little bit more detail around RMDs, the new rules that have RMDs beginning at age 72, it all hinges on your birthday. So as you can see on this slide, if you were born on or before June 30th, 1949, you have to still take your RMDs at 70 and a half. If you're already taking RMDs, you have to continue. And if you turn 70 and a half prior to January 1st of this year, then you have to continue with the old rules. You have to take your RMDs beginning at 70 and a half. If, however, you were born on July 1st, 1949 or later, you are one of the folks that now gets to delay or defer your RMDs to age 72. So July 1st, 1949 is the date. If you were born on or after that date, you now don't have to begin your RMDs, required minimum distributions, until age 72. Once we determine exactly when your RMDs start, there are a couple of other provisions or details that come into play. So whether you have to take your RMDs when you turn 70 and a half or 72, the rules state that you have to take your first RMD, so your first required minimum distribution, by April 1st of the year after reaching either 70 and a half or 72. So in this example, in this slide, we'll talk about someone that's eligible to now start their RMDs at 72. So let's say, for example, that you're turning 72 in 2021. Well, that's a bad example because that would mean you're eligible for the other rules. So let's say you're turning 72 in 2023. That means you're eligible to defer your RMDs until age 72. So you turn 72 in 2023. You don't have to take your first RMD until April 1st of 2024, the year after you turn 72. But here's the trick. You also have to take an RMD for your 73rd year. So you have to take your first RMD by April 1st of the year after you turn 72. In this example, that would be 2024. But you would also have to take a second RMD for 2024 itself. So if you delayed your RMDs, you would have to take your age 72 RMD by April 1st of 2024. You'd have to take another RMD by December 31st of 2024, and that would be for your age 73 RMDs, and then they would continue on the calendar year thereafter. Unless you're doing some really complex or strategic tax planning, I tell most folks to go ahead and take it in the year that you first become eligible to take required minimum distributions, just to kind of help simplify things. And just to take a step back and explain what RMDs are, the way RMDs work in simple terms is if you are required to take a required minimum distribution, you would first look at the value of your IRA account or accounts on December 31st of the prior year. You take that balance, you take your current age, let's say it's 72, and to keep the math simple, let's say in the year you turn 72, your life expectancy, according to the IRS mortality tables, is 87. That means you have, according to their tables, 15 years left to live. So you would take your account balance at the end of December 31st, the prior year, divide that by 15, and that would be your required minimum distribution amount for that year. And then you just repeat that process each following year. So at the end of that next year, you look at your account balance, you then look at the new life expectancy tables, which may or may not have changed. You figure out your life expectancy, you divide the prior year end balance by your life expectancy. That's your required minimum distribution amount. I work personally with Fidelity. My clients' accounts are at Fidelity. And I recommend that you set these up on autopilot. That prevents the risk of missing them and incurring penalties, as well as we can then rely on Fidelity to calculate and send those out for us. And so that just adds a little bit additional help, security to the process to make sure that we don't miss any deadlines or incur any tax penalties. Any questions on that? Type them into the chat box or the Q&A. I'll be glad to entertain those, and then we'll move along here. So let's look at a couple of examples. So we've got a couple that are both 73 years old, Jane and John. They need $40,000 income from their retirement accounts to support their lifestyle. Now this could be in addition to pension income, Social Security income. They might even be working, one of them might be working part-time, doing something, driving for Uber or Walmart greeter or whatever the case may be. But in addition to other income sources, they need $40,000 per year out of their retirement accounts to support their overall lifestyle. Their 2020 RMD, so their required minimum distribution amount for this year, is $32,000. And so as a result, their required minimum distribution amount of $32,000 is addressed by their overall retirement need of $40,000, which means they're taking out an amount higher than their RMD, so their RMD is covered. They don't have to take out anything additional to meet their RMD because the $32,000 is clearly less than the $40,000. And I might be kind of stating the obvious here, but this is where it might become a little bit more clear. So Tammy and Tommy are 72. They also need $40,000 income from their retirement accounts each year to support their lifestyle. But their 2020 RMD is $67,000 because they've accumulated a large retirement account or accounts. And as a result, they have to take out a larger amount of money. So in this example, since the money they need is $40,000, but they need to take out $67,000, their regular income is not going to meet their RMD, which means they need to take out an additional $27,000 above what they need to support their lifestyle in order to meet their RMD. If they just take out the $40,000 to support their lifestyle, they're going to run afoul of the IRS and incur penalties, and it can just turn into a mess. So in this instance, they're going to need to take out more than they need to support their lifestyle to meet their RMD. And depending on the dollar amounts and the timing, taking out additional dollars could push them into a higher tax bracket. It could impact their Medicare premiums. It can do a lot of things. So there's a lot to be said for looking at this and thinking about it strategically. hopefully well before you get to the age where you have to start taking required minimum distributions. So talking about required minimum distributions, there have been some changes, clearly. What's the best thing to do? Well, as I just mentioned, the best thing to do is to plan ahead, hopefully well in advance of the age at which your RMDs or your required minimum distributions start. One strategy that a lot of people talk about and that gets a lot of press is Roth conversions. And basically Roth conversions allow you to pay tax now in the hope or with the assumption that you'd pay less tax later. To give you a quick example, let's say you have $100,000 in a regular IRA. Let's say you rolled it over from your 401k when you retired. Now it's in an IRA. That IRA is going to be subject to RMDs under the rules we just discussed. You could, however, if it makes sense, and there are a lot of considerations that go into this decision, but you could take part of that $100,000 IRA, let's say $25,000, you could actually convert that to a Roth IRA. And what that means is you're going to take $25,000 out of your regular IRA, pay income taxes on that $25,000 today or in the year that you do it, and then you would put either the remainder, if you pay taxes from another source, you still have $25,000. If you pay it out of the $25,000, you'll take whatever's left and put it into a Roth IRA. Once it's in a Roth IRA, it grows tax-free, and the money is never taxed again. That comes out to you later or to your heirs as tax-free income. And so a lot of people, including a lot of financial advisors and planners, say it's better to pay taxes today with the understanding or the assumption that taxes will be higher in the future. So it makes sense to pay taxes today at a lower rate to escape taxes at a higher rate in the future. Speaking personally, I'm not a huge fan of Roth conversions. I think they absolutely make sense in some situations, but I'm not a fan of taking dollars today and accelerating your tax liability today based on the assumption that we know where tax rates are going to be in the future, as well as the fact we don't know how investment returns are going to be in the future. So if you take $100,000, take $25,000 out, pay taxes on it, you have to make up the money paid in taxes before you're back to even and before you're back to growing, basically that $100,000 you started with. So there are a lot of what ifs there, many of which I'm not comfortable with, but Roth conversions are an opportunity to pay taxes now in the hope that you'll pay less later. But again, that's a big hope. You can do some tax planning while you're working. So for example, you might think about redirecting some of your retirement savings today. A lot of 401ks now offer both pre-tax as well as Roth savings opportunities. So maybe instead of cramming all of your dollars into traditional pre-tax 401k savings, maybe you take some of those dollars and you put it into a Roth. What that'll do is it'll reduce your tax deduction while you're working in the year that you make those contributions, but it will subject less dollars to RMD rules down the road because part of those dollars will now be in a Roth IRA. Tax planning after retirement, again, there are some things that you can think about doing with your annual spending. Maybe if you retire at, let's say, age 61, and your RMDs don't start to 72, and maybe you're going to have relatively low income from 61 to 72, maybe you do look at Roth conversions, or maybe you look at some charitable giving, or maybe you look at some other ways to get some of those dollars out from under the RMD rules. You can also look at lifetime planning, which is to say, like, how do you manage your IRA relative to your spouse if you're married, or relative to your children, your grandchildren. And with generational, again, you can look at doing gifting and things like that to help offset. So if you do charitable gifting, that can help offset some of the income taxes associated with your RMDs. There's a lot of ways to look at this, most of which are beyond the scope of our conversation today. The point being, these are the new rules that we're living with. They can and likely will change again at some point in the future, but it's best to think about these and plan ahead. I want to stop and take a quick pause. I recognize a lot of the names of you that have joined this morning, and again, thank you for being here. For those of you that aren't familiar with me or the work that I do, I just want to point you to my website. I've got over 275 articles I've written on everything from retirement to estate planning to financial planning, investing, and a lot more. I've got a resources page where I've got some free guides and courses and downloads that are available to you. And as a thank you for you being on this call today, for those of you that aren't clients, I'm gonna offer a free retirement consultation, and there'll be some more details on that as we get to the end of the presentation. Before I go on, I don't see any questions or comments. If anyone has anything, just type those into the chat or the Q&A, and I'll be glad to address those. So back a couple slides ago, we talked about the two big changes. One was the changes to RMDs, required minimum distributions. The second change was the stretch IRA going bye-bye. So first of all, what is a stretch IRA? So a stretch IRA means if you own an IRA or retirement account and you pass away and that IRA goes to a non-spouse beneficiary. So whether you're married or not, let's say you have that money go to a child. That child could then roll that money into an inherited IRA. So it's a special account, IRA account that you can set up at Fidelity or one of a dozen other places. And once your child inherits those dollars, he or she will have to begin taking their own required minimum distributions each and every year for the rest of their life. So let's say you're 80, you pass away, part or all of your IRA goes to your adult child who is, let's say, 52. He or she will have to take a required minimum distribution that first year, and they'll have to take required minimum distributions each and every year for the rest of their life expectancy. However, since they're 52, they have a much longer life expectancy, and so they can, and pay close attention here, they can stretch out the tax liability on that inherited IRA. Whereas if you kept it and you're age 80, clearly your life expectancy is a lot shorter, and so those tax liabilities would be compressed over fewer years. So the stretch IRA has been around for years and years and years. It's been a vital financial planning and estate planning tool. But with the Secure Act, the stretch IRA goes away. So basically, if you're a designated beneficiary, and a simple way to think of a designated beneficiary is, does the beneficiary have a birthday? Examples of non-designated beneficiaries are, like if you ever list, quote your estate as a beneficiary on a trust, or if you leave it to a certain type of trust, or basically to a non-individual entity, those are generally considered non-designated beneficiaries, and those rules haven't really changed. These new rules apply to designated beneficiaries that are not a spouse. So if you're married and something happens to you, you can basically pass your IRA or IRAs to your surviving spouse. They basically, your surviving spouse basically takes those IRAs and treats them as their own. And they can, again, if they're not at required minimum distribution age, they can defer until they reach age 72 and then start taking the RMDs just like it was their own IRA. In this scenario, we're basically talking about non-spousal designated beneficiaries. So this would basically be virtually anyone that's not your spouse. It could be a child, a grandchild, a friend, an other family member, a sibling, etc. And the kicker with this new rule is if you pass away and part or all of your IRA goes to a to a designated beneficiary that is not your spouse, the beneficiary has to take all of those dollars out over 10 years. And so when I commented earlier in the presentation that maybe they should have called the Secure Act a Tax Revenue Acceleration Act, this is what I was referring to. Now, instead of a non-spousal beneficiary being able to stretch an inherited IRA out over their lifetime, and potentially even the lifetime of their heirs or their own beneficiaries, now a non-spousal beneficiary has to take out an inherited IRA within 10 years after the date of death of the account owner. A couple of points to make here. Let's say let's say you inherit an IRA from a parent that passes away later this year. They would be subjected to these new rules. You would not have to take out any money in years 1 through 9, but you have to take all of the money out by the end of year 10 after the date of death of the account owner that passed the IRA assets to you. There's some flexibility within these structures, which we'll talk about in a minute. But the bottom rule, the bottom line is, if you inherit an IRA or a retirement account as a non-spousal beneficiary, in most cases, you're going to have to take all that money out and pay all those taxes by the end of year 10. So that's the real kicker here. I got a question from Jim. Does the 10-year rule also apply to inherited Roths? Thanks for the question, Jim. And what Jim's asking is, let's say you inherit a Roth IRA as a non-spousal beneficiary. The 10-year rule still applies, but fortunately with Roth IRAs, you're not paying income taxes. So you have to take all the money out within 10 years or by the end of the 10th year, but there's no tax liability to do that. Basically, they're saying you have to clear all the money out of the Roth IRA by the end of year 10 and just put it into a non-retirement account. Thankfully, there's no taxes associated with doing that. So thanks for the question, Jim. If anyone has any other questions about any of this, please type those in. So Bobby asks, does this rule apply to thrift savings accounts? Yes, it does. My understanding is that a thrift savings account, for those that aren't familiar, is basically the equivalent of a 401k account for certain government employees. So it's basically the government's version of a 401k. It's actually a great retirement plan because it's very low cost and it has really good investment options in there. But ultimately, once you retire, if you leave your money in your thrift savings plan, or if you roll it out to an IRA, these same rules apply. If it's your thrift savings plan, you only have to worry about RMDs. But if you pass away and you designate a non-spousal beneficiary to receive part or all of your TSP, your thrift savings plan, they'll be subjected to this new 10-year payout rule. So thanks for the question, Bobby. Hopefully that answered it. So I mentioned designated beneficiaries. Again, those are beneficiaries that have a birthday. Non-designated beneficiaries are typically going to be a trust. If you list, quote unquote, your estate as a beneficiary, which I generally recommend against, those are designated beneficiaries. Non-designated beneficiaries have basically the same rules they've always had. If a non-designated beneficiary receives a retirement account after you pass away, they have to take all the money out by the end of 5 years. So, and this rule has been the same for a while now. One caveat, which I'll touch on a little bit more in a minute, is the age of the account owner when they passed away. But I'll touch on that again in a minute. So just to give you a little bit more context around beneficiaries and who falls in what category. So an eligible designated beneficiary, so these are beneficiaries that can receive an inherited IRA or an inherited retirement account and not be subject to the new 10-year rule, which I just covered. So this includes minor children of the decedent. So if an IRA owner passes away and they have a minor child or children, they can receive the IRA and not have to start the 10-year payout until they reach age of majority, which for most states is age 18. So let's say that you own an IRA, you pass away, you've designated a minor child as a beneficiary, and they're 5. So from age 5 to 18, they can keep that money in an IRA. They don't have to take out, they actually do have to take out required minimum distributions, but they don't have to pay out the 10 years until they turn 18, at which point the 10-year clock starts and they have to take all those dollars out by the time they reach, in this example, age 28. Other eligible designated beneficiaries include disabled people, if you're chronically ill, if the beneficiary is not more than 10 years younger than the decedent, spouses, which I touched on earlier, and some trusts. And this would be ground to cover with your estate planning attorney, or this is something we can maybe address in a future presentation like this. Designated beneficiaries are non-spouses in some trust. So think of this center column as these are the folks that are going to be subject to the new 10-year payout rule. So if you fall into this column as a designated beneficiary, some trusts, non-spouses, you're going to have to pay out all of the inherited IRA or account assets you receive by the end of year 10 after the date of death of the account owner. And then finally, non-designated beneficiaries. So if you leave your IRA or retirement account to a charity, if you name your estate as a beneficiary, which is basically saying it goes to whatever your will says, some trust accounts, again, as I said earlier, these are basically entities that don't have a specific birthday associated with them. So these would be subject to the 5-year payout rule. If the account owner passes away before their required beginning date. So I apologize for throwing yet another acronym at you. Required beginning date is when your RMDs, your required minimum distributions, are required to start. So for a lot of people, that's now 72 instead of 70 and a half. So let's say that your mom passes away. She's 71. She passes away later this year at age 71. Another bad example, I apologize. Let's say that your mom is 68 and she passes away later this year. So she has not gotten to close to her date when she has to start taking required minimum distributions. So she passes away prior to her required beginning date because she has not fallen under the requirements to start taking her distributions from her IRA. That means she would pass prior to her required beginning date. And if a non-designated beneficiary receives part or all of her IRA, they have to take all of it out by the end of year 5. If, using that same example, your mom is 72 and passes away later this year, she had already begun taking out her required minimum distributions. One of these non-designated beneficiaries can actually receive the inherited IRA account or retirement account assets and take them out, take required minimum distributions out each year for the rest of their lives based on the single life expectancy payout of the account owner. So based on your mom. So if your mom was 72 and her life expectancy was, let's say, 87, using the example from earlier, she has a 15-year life expectancy. So the first year you would basically divide the account by 15. The next year you might divide it by 14 and so on and so forth until the account's paid out. But that's clearly better than having to pay it out over 5 years. I know I'm throwing a lot at you. I don't see any questions or comments, so we'll go ahead. If you have anything for me, please type them in. So let's talk about a couple of examples. So let's say Renee is 57 and she plans to retire at age 60. She earns $175,000 per year in her current job. And let's say she inherits an IRA from her mom that's worth about $490,000. So Renee has a couple of options under these new rules. She can, she has to take all the money out in 10 years. So she can either take out $49,000 a year, each year for 10 years. That assumes there's no growth, et cetera, in the account. But she could take out $49,000 each year for 10 years. Or if she plans to retire in a few years, so she's 57 and plans to retire at 60, she might instead defer those payouts for the first 3 years while she's still working. At age 60, she retires. Her income of $175,000 goes away. She might have other income from other sources or a pension or what have you, but the main source of her income, $175,000, goes away. So likely she would fall to a much lower income tax bracket. So then she might want to start the payout. She would have 7 years remaining since she's waited 3 years. But if she took out $70,000 a year for 7 years, that would be after her retirement, after her income goes away, and she would much likely be in a much lower tax bracket, thus keeping more of the IRA assets and having to pay less in taxes. So something to think about there. Let's see. Another example. Donnie and Marie just retired at the end of this last year. Their retirement plan is based on them spending $120,000 per year throughout the rest of their lives, throughout their retirement. Donnie's dad, who's a widower, is not in great health, and he has accumulated an IRA worth $1.5 million. And Donnie is, he's an only child, he's the sole beneficiary. This brings some interesting planning opportunities to the table, because if you think about the timing of inheriting an IRA, especially a large one, like $1.5 million, that can add some additional considerations and make the planning decisions that more tricky. For example, you might want to think about the tax bracket that Donnie's dad is in. So even though he's accumulated a lot of assets, he may or may not be in a high tax bracket. So maybe there's some things that Donnie's dad could do while he's still living to reduce the potential tax liability that Donnie and his wife Marie are later going to have to deal with. As an example, Donnie's dad might think about doing some Roth conversions if he's in a lower tax bracket, thereby paying some of the taxes today at his lower tax rate than Donnie and Marie might have to pay when they receive those assets based on the 10-year payout rule. You'd also want to think about triggering of income-based Medicare premiums. So the trigger, the dollar figure at which Medicare premiums start to increase based on income is $174,000. Well, if Donnie and Marie inherit that entire $1.5 million IRA and they take out $150,000 per year over 10 years, on top of the $120,000 they're already spending to support their lifestyle, they're going to be well above that Medicare premium trigger. And so that's just going to add to their tax liability. And also as income goes up, whether that's from your own retirement resources or inheriting assets, that could have other tax ramifications. Any way you slice it, it's likely that in this example, there's going to be less after-tax inheritance for Donnie and Marie from Donnie's dad. And that may or may not be an issue. You could argue that's a first world problem. And let me take a moment to say, like, I think that all financial planning should be based on your lifestyle and what's important to you. I don't think that you should ever let taxes and tax planning completely rule or override your decisions. But clearly, it makes sense to consider the taxes and to find a happy medium between prioritizing your life and what's important to you and making smart tax decisions along the way. So what are some planning opportunities here? If we're talking about the stretch IRAs is going away, well, one thing I would do is perhaps review your parents' beneficiary designations. So let's say that you have a sibling, your mom and or dad are still living, they've got some retirement accounts, and they plan to pass them along to you and your sibling in equal amounts, 50% each. What you might consider doing is maybe adding a third or fourth beneficiary and splitting it 4 ways and adding maybe a grandchild. That would further spread out the tax liability. And maybe if you're well prepared for your own retirement, you're not really depending on inheriting assets from your retirement accounts from your parents in this example. And ultimately you want to pass that on to your children anyway. That might be a smarter and more tax effective way to do that. Something else you might think about is consider and plan for lifestyle needs before tax planning. I mentioned that just a moment ago. As easy and sometimes interesting as it can be to think about all the tax ramifications, I think it's ultimately important to prioritize your lifestyle and really what you need and what's important to you. So again, don't let the tax tail wag the dog, so to speak. But at the same time, I think it's worth considering these tax aspects. Maybe discuss your parents' retirement accounts and what they're doing. Does it make sense for them to consider Roth conversions? Maybe they could do, if they're charitably inclined, let's say they're giving money to their church or their synagogue or their parish or to an organization or two that are important to them. but they're doing it outside their IRA. Well, you can actually utilize something called another acronym here, a QCD, which is a qualified charitable distribution. You can actually give money directly from your IRA to a qualified charity, a 501c3, up to $100,000 a year, and you don't pay income on those dollars. It's basically taking taxable dollars out of your IRA, giving them to a charity, and eliminating that tax liability. You don't also get a charitable deduction, but you eliminate that tax liability. If your parents are charitably inclined, and let's say they're already giving money to a charity, but they're doing it out of other accounts, maybe they could start doing that out of their IRA using qualified charitable distributions to help minimize the IRA balance that might maybe get passed to you later, and eliminate more dollars that would be subject to the 10-year payout. And then Roth conversions for yourself. If you're potentially going to inherit an IRA in the future or a retirement account in the future, you might consider doing Roth conversions on your own dollars to get fewer dollars out of retirement accounts that they're going to have tax liabilities associated with them in the future. As I mentioned earlier, I'm not a huge fan of Roth conversions. I don't do many of these. I've actually talked a lot of clients out of them, but that's an option, and a lot of people like to consider those. So talking about beneficiary planning, let's say your dad is 84 and has a $1.8 million IRA. And I see I'm running a little bit long on time, so I'll try to wrap it up here. Rather than your dad leaving this entire $1.8 million IRA to your mom at his death, he's leaving half to her, and he's splitting the other half between you and your brother. And what this does is this creates a 10-year payout window on one half, so $900,000 that's being split between you and your brother. Now you each have 10 years to distribute $450,000 that you each inherit. Whereas if he'd left it all to his surviving wife, she would have $1.8 million, and she may or may not spend some of those dollars down. But if she passes away and passes the entire $1.8 million to you and your brother, you now have to split $900,000 and take all those dollars out over 10 years. So this is a way to maybe consider leaving IRA or retirement account benefits directly to a child, in addition to a surviving spouse, to help spread some of this tax liability out. You could also, as we touched on earlier, you could also add minors or grandchildren to further spread out the tax liability. So you could say you leave 25% to your surviving spouse, another 25% to you and your brother, and another 50% is split between your 4 grandchildren. And let's say some of the grandchildren are minors. Well, again, if they're minors, they can receive the IRA, inherited IRA. They have to take RMDs until they reach age 18. Once they reach 18, they have to start the 10-year clock, after which they have to pay out all those assets. But if, let's say you've got a new 1-year-old, they can in effect spread out the IRA payout window for about 27 years, because they would only have to take RMDs until they reach age 18. Once they reach age 18, they have another 10 years till they get to 28 to take out the full IRA payout. So again, just a little way to think a little bit more strategically about who and how you name your beneficiaries. So wrapping up, I can't say this enough about planning in general, but specifically about retirement planning around the Secure Act. Plan early and often. It's a very different conversation, and you have a very different set of choices and flexibility if you're planning all this when you reach age 71 versus starting to think about it when you're 61. Plan for yourself first, but also think about and maybe discuss what your parents are doing around their planning. And I know that can be a touchy subject. People don't like to talk about money in general, certainly not with their parents, but it can be an important discussion to have, and it could frankly save maybe your parents, but probably you and your children and maybe their children a lot of money in taxes down the road. Think about charitable strategies that could facilitate both tax planning and charitable intent. Like if you're not already charitably minded, I'm not sure this makes a lot of sense, but if you are giving money to charity, think about using retirement dollars to do that in a more tax efficient manner. Consider strategic beneficiaries. So we just talked about like maybe splitting beneficiaries. Instead of having everything go to a surviving spouse, maybe have part of it go to a surviving spouse and have part go to children or grandchildren, etc. Roth conversions. Maybe consider some partial Roth conversions to pay some taxes now to avoid paying them later and get more dollars out from under the RMD requirement. And I'll say, this is back in 2018, we had the Tax Cut Jobs Act. We had this at the end of 2019. I expect more change in the future with regard to legislation around retirement. We're gonna certainly see changes in tax rates and things like that. That's why I'm a little hesitant to make any long-term plans based solely on what we know today. But I think still these are the rules we're now playing by. So we need to be cognizant of them and think about them. And as I've said before, don't let taxes drive your decisions. Plan for you, your lifestyle, what's important to you first, and then consider the tax implications or the ramifications of your decisions as it relates to tax. So that wraps it up. I went a little long, so I apologize. Thank you for joining me. If you have any questions or comments as we're wrapping up, please type those in. I'm happy to hang around and address anything that's on your mind. I did want to share that, as I mentioned earlier, anyone that's on this call, I'm happy to offer a free, no obligation retirement consultation. If you want, you can go to my website. It's wealthcareforwomen.com/call. And you can go through a few steps and schedule a call directly on my calendar. I work with clients both here around the Atlanta area as well as across the country. So if you have questions to follow up any of this or about anything else regarding your retirement planning or your financial planning, I'd be happy to spend some time and discuss it with you. This is for the lawyers. So I work in a highly regulated industry. So this is a link to my disclosure information. So if any of you are having trouble sleeping at night, click this link, read through it. It'll knock you out and you'll sleep like a baby. That is all I had that I wanted to share with you today. So before I sign off, I don't see any questions or comments. If anyone has anything that they want to ask or a comment they'd like to make or they want me to review or revisit anything I touched on in this presentation, please type it in. I'm happy to do so. I'll give it just a minute. I'll go back to this screen. So you've got my contact information and you're welcome to reach out via email or call me directly. This is my direct phone number. All right. Well, as I said, I went a little bit long, and I apologize for that, but I appreciate you joining me and sticking around with me. We don't have any questions or comments, so I'm going to wrap it up. Thanks for joining me. I hope this was helpful. I hope you got some information and some thoughts that will help you in your own retirement planning. And as I said, if there's anything I can help with or that you'd like to discuss, please feel welcome to reach out and let me know. And I would be happy to discuss your retirement plans and the Secure Act with you further. So one last check, no questions or comments. All right, thanks everyone. Appreciate you joining me. I'm gonna wrap it up and we will talk to you all soon. So take care.